Ladies and gentlemen, welcome to Destination Retirement with Robert Kuhn.
Time to get on board with Robert Kuhn from Kuhn Capital Partners. Retirement is a destination you've spent decades saving for, and what you do with those savings can make all the difference in the life you live once you get there. Income planning, wealth planning, tax planning. Destination Retirement with Robert Kuhn starts right now.
Welcome. Thanks for listening to Destination Retirement. I am Robert Kuhn, the host of this radio show, also president and founder of Kuhn Capital Partners. If you haven't listened to the show before, we're independent. We're a registered investment advisory firm, and yes, we are fiduciary. Generally, our clients are in retirement or within 10 years of retirement that are tired of basic asset allocated models. You know, we talk a lot about alternatives on the strategy, or on the radio show, alternative strategies rather, on the radio show, and we love it. We're going to keep doing it because it's a competitive advantage for us when you can talk about strategies that can produce double-digit returns with 30% downside protection, or strategies that can greatly reduce your taxable income. Give Paige a call at 630-492-1912, 630-492-1912. A couple things on the banknotes. I want to start using the actual name of most of the banknotes. I say banknotes just because they're simplistic, but they're enhanced yield income notes. That's what they are. Enhanced yield income notes offered by the largest banks in the world: JP Morgan, Citi, Bank of America, Morgan Stanley, UBS, etc. So when we talk about downside risk management, it's not that we believe that the markets are going to go down. They're going to go down at some point. I mean, math tells us that. But they've only been down 16 times since 1950. So that may make you feel like, well, you just need to buy something and hold it and never, make any changes. And, that could be right if you look at, over, the very, very long term. But I want you to think about, what is your time horizon? I mean, because again, we've seen periods of time in the market where the markets have stayed down for an extended period of time. And I often talk about on the radio and in the dinners that we host and in all of our meetings with current clients and, potential clients that, this isn't a debate of whether the markets go up or down. Markets go up over time. How much? That's the variability, of course. But the markets can stay flat to sideways for an extended period of time. And if you're, within 10 years of retirement, or if you just retired, or if you're in retirement, you don't have to go too far back to see the markets not grow. And we can go back to 2000, and where we saw, an S&P that, didn't do a whole lot from 2000, or anything for that matter, from 2000 to 2009. Or if you bought Microsoft, it took you 14 years to get back to even if you bought it in 2000. So think about that. 2000, it took you 14 years to get back to even. Yet the stock did, the earnings from the company were off the charts, but that didn't mean that you were doing well. So, trying to make predictions is, I think it's a very challenging game, but that's why most advisors are just going to say, don't worry about it, hold, money goes up over time. Okay, fine, but that should not be good enough for you, because what about when the markets are down? What do you have inside of your portfolio? If you're not giving anything up on the upside and you are just now enhancing your portfolio to be able to make money in a down market for some of your money, well, isn't that the job of an advisor? I mean, isn't that the job of somebody that you're entrusting your money with? Because if you are okay with, well, the market's down, don't worry about it, you don't need the money today, the plan says X, hold it, it'll come back, you don't need an advisor. And I'd say 9 out of 10 people who reach out to the radio show, 630-492-1912, the reason they reach out is because of the banknotes. I got to stop saying banknotes. That's just what we say, enhanced income yield banknotes. But that's why they reach out, because their advisor is just has no clue what they are. And I stop and think, okay, well, if you're working with an advisor, beautiful office, beautiful this, beautiful that, manage hundreds of millions, whatever, billions, it doesn't matter. And why aren't they offering it? And we inevitably are always asked that question 9 out of 10 times. Why doesn't everybody do this once someone understands what it is? Because they're rather simplistic. And I'm going to get to what we've created or are creating here in a minute for education purposes, but they are relatively simplistic. Well, they're incredibly simplistic. But again, why doesn't every advisor do it? Well, a couple of reasons. Number one, they don't have access to third-party, unbiased products, and so again, we're not using Kuhn Capital Partners enhanced yield banknotes. I mean, these are J.P. Morgan, Citi, Bank of America, Morgan Stanley, UBS, Goldman Sachs, BNP, et cetera. So these are the biggest and the best banks, and it's a $200 to $300 billion a year space. I mean, think about that: $200 to $300 billion a year. It's just generally speaking a higher net worth strategy. Private office, family office, private wealth management, private bank, kind of institutional quote unquote type strategy. The average retail advisor, which focuses on clients generally between $500,000 and $10 million, they just don't do them because they are a tremendous amount of work. A tremendous amount of work for us, not you. They're very simple. But it's a tremendous amount of work for us because these get called so frequently. Again, it's not callable for 6 months. But in up markets, they're called all the time. And think about that. You have, millions and millions and millions of dollars in these notes and you're, millions, 20, 30, 40, 50, whatever that number is, that you're going to do on an annual basis. And these are called, every 6 months or 8 months or 9 months, depending upon when the market ultimately comes back to positive. If it is down and they're not called right away at 6 months, that's a lot of work. It's a lot of work for my team. But again, I don't care because if you meet with us, if we have met with you, if you're a current client, if you've attended one of the dinners that we do throughout Chicago, you understand that it's not our agenda. It's your agenda. And I make that very, very clear. And so many clients that we meet with they just feel that sense of, okay, I can breathe. You're not here to pitch me. You're not here to tell me what I'm doing is wrong. You're not here to sell me your agenda. You're here just to listen. You're here to listen. You're here to, first of all, develop a financial plan. You're here to make sure that I have at least a baseline of a financial plan. You're here to look at, Roth conversions. We had a story the other day, a client, bigger client, soon to be client, but their current advisor said, Roth conversions don't make much sense because, it's going to bump you up into a higher tax bracket this year. Well, maybe for 1 year, maybe for 2 years, but let's look at the life. This individual was in his mid to late 60s. And we ran a tax analysis on what his RMDs that the government was going to force him to take out. And this individual just came up with that he was going to have to, over a life expectancy, we just ran it to 95, right? But was going to pay well in excess of $5 million in taxes just from RMDs. I don't think people fully recognize that if you have a 7-figure IRA, just how much you're going to have to pay over the life of that investment to the government because of RMDs, and then you're taking Social Security. And so the advisor was 100% right. Yeah, it doesn't make a whole lot of sense if we're looking at it year over year, or kind of in a vacuum, this year, next year, or the following year, et cetera. But we looked at and we created a strategy that, yes, if you do pay a little bit more in taxes over, I think this one happened to be 5 years, over the life of the plan, we targeted, because you don't know the growth rate, right, of future assets. Nobody knows that. So we assume a relatively meager, well, not meager, I guess, but a 7%, growth. So again, we don't know what the growth rate will be. It could be significantly higher, and your tax bill could be, significantly greater. But we assume a 7% growth rate, and we were able to show him that, no, we can actually cut your lifetime tax spend in half by just paying a little bit more in the first handful of years. And oh, by the way, we have an energy strategy that can help reduce the tax on those conversions because of the benefits of the energy strategy. The energy strategy reduces taxable income, $70,000 to $90,000 per $100,000 invested. That's our target. because we don't know, again, what it'll come in at each year. So we just use it, for tax planning, we use 70 because we're very, very confident that we'll get 70,000 per 100,000. Again, that's active income, passive income. So if you have a high net worth, or if you make, a significant amount of money, and significant amount of money is different to everybody. I mean, I may say, a lot of money is $1 million a year, and people will say, well, it's not that much. And I'll say, well, maybe a lot of money is 100,000, and people will say, well, my gosh, that's a ton of money. So significant is relative. It's relative to whatever you think significant is. What I think significant is, what other investors and individuals think significant is. It's irrelevant to your situation. Again, we're not comparing people here. We're looking at your situation. But we were able to, greatly reduce, the taxable income. Now, again, I'm not a tax advisor. I'm not a CPA. I'm not licensed to give tax advice. This is all for educational purposes only. Best practice is to always talk anything tax related is to talk with whoever, your tax professional is. So I want to make sure you know that. But these are very basic tax strategies. And we can show that through our financial plan. We can actually model that out every year. And what I have found is the people who have under $1 million generally always want to do Roth conversions. Those that have $1 million to 10, $1 million to 15 million of investable assets, they don't think that they can do Roth conversions because it doesn't make sense. Well, my goodness, you actually have the means to get very, very creative on doing Roth conversions. And when we can model that out, where we could look at every single year of your plan to age 95 and look at what your, what we would anticipate with an assumed growth rate your RMD would be, that is called financial planning. That is the extent of financial planning that the level of detail that we take it to. And most people aren't doing that. 630-492-1912, 630-492-1912 if you want to really learn about that. And then we have, tax planning software that will take your previous year's tax plan, and we can look at, when we're considering Roth conversions, it'll show, it will blow you away. We absorb the cost of it. 9 out of 10 advisors don't do it because they don't want to pay the cost. But we do because it's the only way that we can look at tax preparation over a 10, 15, 20-year time horizon. We want to pay all the tax we have to. But my goal is nothing more. And when you look at the Roth IRA, and you can pass that on tax-free, let that grow for 10 years for your beneficiaries tax-free, and then they can take that money out tax-free. Man, it's a story you want to hear. So 630-492-1912, 630-492-1912. More after the break.
Planning for retirement is kind of like planning for the trip of a lifetime. First, you save and plan every detail. Then comes the day you've looked forward to for so long. Preparation is the foundation for successful travel and retirement. At Kuhn Capital Partners, we believe that foundation is a financially secure and tax-efficient plan that seeks to protect your needs now while looking to the future. Reach out to Robert Kuhn at 630-492-1912 and visit our website, KuhnCP.com.
Back to listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners, independent, registered, and yes, we are a fiduciary. I want to thank everybody for listening. If you're catching it on the podcast, send it on to someone you think could benefit from it. We would greatly appreciate that. Again, kind of going back to finishing up, what I was talking about in the first segment, on the banknotes and kind of what we're doing. Well, first of all, 630-492-1912, 630-492-1912. If you'd like to get on our calendar and have a conversation, we would love to do that with you. Paige will set that up and my team. But getting back to the banknotes, the enhanced income yield banknotes. That's what the name is, enhanced income yield banknotes. And I'm going to have to catch myself. I wonder how many times I'm going to just say banknotes, but enhanced income yield banknotes. They are a prospectus item. That's what, most people love to know because, when you do it says right there, guaranteed by, the bank and whatever the bank is in the prospectus. But what we've done, given the interest in it, and candidly, I think out of, the Chicago area, we should, as a firm, our goal is to do $100 million minimum of new client enhanced income yield banknotes because really candidly where the market is. And when you can, provide a level of, first of all, the financial planning, the tax mitigation, especially the tax mitigation. Unfortunately, tax mitigation, tax reduction is just the most overlooked area of financial planning. If you don't, just simply ask your advisor, whether at a big bank, a big brokerage firm, ask them if they have the availability to invest in a strategy like Bison 2 LP that can reduce your taxable income by a targeted $70,000 to $90,000 per $100,000 invested in the year that you invest. In the energy space, most people in the Midwest, especially here in the Chicago area, advisors don't focus on energy, and if they do, it's common stocks, and that is what it is. You get no tax benefits, dividend, but no tax benefits, right? But in the energy space, it's a massive tax benefit space. And in the way our fund is structured, is these tax benefits have been around forever. Ever. And you can reduce your taxable income by, on average, $70,000 to $90,000 for every $100,000 you invest in the year you invest. And it's a cash flow total return story. You get the distributions. We're investing directly alongside of the majors in their projects, and the Exxon, Chevrons, Conocos, Matadors, Mewborns, EOGs of the world. So think about that, though. If you put in 100,000, 200,000, a million, whatever it is, and you can reduce your taxable income, what could you do with that? Well, A, you can reduce your active passive income. That's huge. B, you could do Roth conversions and minimize that income that the tax on the additional conversion. Or C, you can reduce capital gains if you have concentrated stock positions, or if you sold a business, or if you sold a property. Those are very intuitive ways, or ingenious ways, in my opinion, to reduce your taxable income. And I have to always say, when we talk taxes, it is educational purposes only. We're not tax professionals, can't legally provide tax advice. So anything we talk about, please always, take for just informational purposes. Best practice is to always, talk with, your tax professional, and we'll talk with them with you as well. That's not the issue. But these are very, very, very black and white strategies. But on the banknote strategies, the enhanced yield income note strategies, they are so popular. Again, our goal is 100 million of new investor money, people we've never met before in the Chicago area and really nationally. But given that we're headquartered here, we do $100 million in over the next 12 months of enhanced yield income notes. And so we're creating again, education. It's all about education. I think any person that invest with us, they will tell you they felt that they were very, that we just educated, that we weren't here to tell them this, that they're doing is wrong, like every other advisor does, that we're just bringing something unique, something different, and really just trying to educate and get you to understand a rather simplistic strategy that's just not used by the retail advisor. It's used more institutionally. But we are creating an educational series on the banknotes with some videos that will articulate what they are, what they're not. So hopefully we'll have that page up and running soon. I am doing a webinar. Well, I've done webinars, but we're actually doing a formal webinar that will go over it. So if you want to take a look at that, excuse me, before we have a formal conversation, certainly just call Paige. 630-492-1912, and she will send you the link to that webinar so you can watch it. That's perfectly fine as well, so no issues there. But that's our goal. So if you're working with an advisor that does not have strategies in your portfolio that can do well or make you money in the negative market for some of your money, you really owe it to yourself, because I'm concerned. I'm concerned about the market. It doesn't mean it's going to crash. We know markets over 20, 30, 40, 50 years, 15 years even go up. But does that mean that you should not have something in your portfolio that can mitigate the losses of your equity portfolios if the markets go down? Think about that. Most people, unfortunately, are still using bonds as a diversifier. Go pick your favorite bond fund. Look at the return over the last 10 years. I'm going to probably guess it's under 2%. What are you doing investing in that type of a strategy under 2% because it's quote unquote just what everybody does, right? Well, no. The lazy retail advisor that doesn't focus on higher net worth strategies, that's what they do. That's not what we do. And it's an issue. It's an issue, but it's a competitive advantage. Let's face it. It's a competitive advantage. I am a competitive person, and we want to win. And when we win, the clients win. And that's my job. We're okay with having, before you become a client of ours, of giving you the financial plan complimentary. And it's going to be as detailed and as thorough of a tax analysis that you've ever seen. We're able to run our tax software on, spelling out, how can we mitigate your lifetime tax that you're going to have to pay to the government? And, if you so choose to pass money to future generations, how can we do that as tax efficiently as possible? Those are the things that we're going to talk about. And guess what? It costs you $0. Absolutely $0. And now people may say, well, if it's free, it's not good value. No way. Not a chance. I could probably charge $2,500 to $5,000 for the plan and the tax analysis. And if that's what you want, and you don't want to work with us, and that's only what you want, then we'll charge you. Fine. But it is something that is just a commitment on our part to show you the level of detail that we go to before you are even a client, because we look at we're mid-year, right? We're getting close to mid-year, and the 2025 mid-year outlook, economic outlook that I'm seeing, again, it's these are opinions. They're opinions from me. They're opinions from investment banks, which generally you're not going to get the real opinion, because are they going to scare you and then, have you move money or become, move money to cash and then them lose, whatever fee revenue they're generating? Probably not. But, we listen to people who generally, we listen to everybody, but generally we put more of our stock in opinions or analysis or, mathematical models of people that have, the bulk of their personal net worth, tied up in what they're saying. I just think that's more objective. And to me, that's a big difference than what most advisors do. Unfortunately, I'm convinced that most advisors that you're talking with, that you're working with, are managing their personal assets significantly different than they're recommending you to invest. My belief is that they're recommending you to invest in a very cookie cutter strategy because it's easy to understand. Everybody knows what a balanced portfolio is. Everybody knows what bonds are. And when they can invest their client money that way, it's easy for them. They can scale a business that increases their revenue significantly, but you're just left to dry if we have low growth and high inflation. And that's not who we are, because I think global growth, and it's not just me, you can do research on it, but global growth is likely to slow in 25 and 26. And I think the shock of higher tariffs and certainly the debt, it is going to ultimately cause an issue. And I am very, very concerned with that. So I do think global growth is going to weaken, possibly to an average annual rate of around or under 3%. And that deceleration weighs on the rest of the world. And I think when you look at, inflation, some people say it's going to go down. Some people say it's going to go up. It's anybody's guess. But I get very, very concerned with if we're in a slower growth period. The case can be made that it's significantly higher based upon how you look at inflation. Last time I checked, we all need energy, we all need food, right? So how they back out that because it's quote unquote volatile is just a topic for another day. But I am very concerned. I am very concerned that if inflation is what it is, and if you listen to the investment banks, and these are big banks, these are the big banks, and that are saying, an expected 10-year annualized go-forward growth rate, we've seen as low as 2%, and we've seen as high as 4%. And let's just, say inflation, okay, fine, is down. Let's just say it's at 2%. So your real net rate of return, if we're in a lower growth period because of the valuation of the market, is 1 to 2 to 3%. Over the next 10 years, and you're 5 to 10 years out from retirement, or you just retired, or you're in retirement. And again, that's where the enhanced income yield banknotes come in, right? Those are double digits, 12, generally 11 to 15% with 30% downside before we don't get paid those interest coupon payments. And we're going to talk about cash flow here in a minute. But we definitely are going to talk about that. So be on the lookout for the landing page that will have some really easy, intuitive, easily understood videos, access to for you to sign up to a very short webinar. Again, I want to keep it 10, 15 minutes max. So if you want that before you talk to us to get a kind of an understanding of what the banknotes are, we'll certainly do that. So 630-492-1912, 630-492-1912. More after the break. Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn. I am the president and founder of Kuhn Capital Partners. We're independent. We're a registered investment advisory firm. And yes, we are a fiduciary. Our focus, our niche is strategies that can still deliver positive returns or principal protection in negative markets. And you may have 20%, you may have 50%, you may have 70% of your money in that. Obviously, everything is determined based upon our financial analysis of your financial plan. But that is our niche. Our niche is bringing those strategies, those enhanced yield income banknote strategies that will, deliver, generally 11 to 15%, depending upon, where they're pricing at, offered by the biggest banks, the JP Morgan, Citigroups, Bank of America's, Morgan Stanley's, UBS's, et cetera, of the world. With 30% downside before we don't get paid those monthly interest payments. Those are the types of strategies we're bringing to the table. We're bringing to the table significant tax reduction strategies in the energy space, and there is a webinar on that as well. So we can reduce taxable income on average $70,000 to $90,000 per $100,000 invested in the year that you do invest. So give Paige a call, 630-492-1912, 630-492-1912. So let's go through, income planning. And when we do our income analysis, our tax reduction, again, everything that we do, we generally will run out to age 95. Here to help. We're here to educate. We're here to be a part of your team. We're here to be the finance eyes and ears of the investment part of the team. You're the CEO. You're the owner of the fund. You're the owner of the sports team. You're relying on our experience to be able to look and vet things in ways that you simply can't. And people appreciate that. But you've got access to us. You have access to us to do due diligence on investments that you simply can't do to the level that we can do. Advisors are really good at just showing you the pros. And that's why we do the dinners we do throughout Chicago. And, when we think we're the best financial planners out there, we don't think that there's another firm that is going to do the level and go to the extent of financial planning that we do. Tax reduction, minimize taxes, run your tax strategy out to age 95. And again, you don't need to have 10 million. You could have 500,000. You could have 5 million. You could have 100 million. I don't care how much money you have. That, if it takes, we don't, punching in, 500,000 versus 15 million is nothing on the plan. I mean, it's simple to do. But we're going to be able to help you look at things in ways that you can't. And one of the things that I'm so proud of that I instill in everybody that works with us is that we respect current relationships. We are not going to be the advisory firm that says everybody else is wrong. That's just not going to be us. And unfortunately, that's what you find in this industry. We talked with a guy who, a friend of a friend who, they were out downtown and an advisor on my team was, it's an acquaintance of his. And they were, out somewhere and just, talking shop and the guy asked, what's kind of your competitive advantage? And one of our guys said, our enhanced yield income notes. Now bank notes, structure notes, whatever, but they're the enhanced income yield notes. And the advisor said, oh, those aren't good. And it's like, what? And you know why the advisor said it? Because he had no clue what they were. I mean, think about that. No clue. And these guys are opining on strategies that they have no understanding of. And it is just shocking to me. But that's the industry. That's the industry that we are in. That if an advisor doesn't bring you the strategy, they're going to tell you why it's bad. That's not us. That is just simply not us. We want to be a part of your team. If you want us to manage 100% of your money, awesome. If you want us to manage 25% of your money, no issues. But once you're a client, you get my expertise. You get our eyes and ears as financial planners, as wealth managers, as investment advisors, and we can simply do due diligence on things that are going to take you, in my opinion, many years to learn. So I want to ingrain that in with everybody listening on the radio show. I do believe it's a privilege to have our eyes and ears working on your behalf. Why? Because we're objective. We just want you to know not what you're being told. It's like the annuities, right? I can't tell you how many people I meet with that say, "Oh, I'm guaranteed 7%. Oh, I'm guaranteed 9%. Oh, I'm guaranteed I got a 30%, bonus. I got this, I got that." And it's like, well, you don't really understand it. I'm not going to tell you that the advisor lied to you because, you may believe I wasn't in that meeting, but, so I don't know what they said or what they didn't say. But do you think any investment is going to give you a guaranteed 7, 8, 9, 10% of real money a year? Guaranteed. Come on. I mean, not a chance, right? So there's always more to the story. And so our job is to really explain to you every strategy, every investment, the pros, the cons, what we see, how, it's going to reflect in your plan. Because, again, a rather large client, around 8 million, that, well, soon to be client, but, came into the office, and the first meeting, everybody would be falling over themselves to get them as a client. And we said, we can't even make recommendations to you until we know your situation, until we run a full-blown financial plan, until we put several hours into where you're at, where you're going, look at your tax rate and all of that. And that holds true for someone who's got $500,000 or someone who's got 20 million. But that's not the industry. And that is something that we're going to get on our soapbox on, of really making sure that individuals know that, that's when you have a good advisory group. And and when we can educate you on the pros and cons, the real pros and cons, and then we can talk about strategies like the enhanced income yield bank notes, excuse me, that, are giving you, double-digit returns, annual returns, as long as, those indexes aren't down, 30%. That's an appealing story. That is a very appealing story. And when we can, look at what our competitive advantage is, and also bringing to you strategies that can greatly reduce your taxable income, well, that's a competitive advantage. We're not talking about tax loss harvesting. We're not talking about, strategies that, can match gains versus losses. I don't know if I would consider that. I have to consider it tax planning because it is. But that is like, if proactive tax management is like a 10, where, you're using energy strategies to greatly reduce your active or passive income. And we look at what most advisors are bringing to the table and kind of like tax loss harvesting and using that. Literally, we were interviewing an advisor from to bring onto our firm, and we asked, hey, tell us about what you do on the tax strategy side, and what do you do for your clients to reduce, their taxes. And they thought, and this is a huge bank that he was a part of, a huge bank, big brokerage firm that's part of that bank. And he sold us that, tax loss harvesting is what we do. And they are holding that out as proactive tax management. And it just, I shake my head. Anybody can, match gains with losses, but can you show me a strategy that can reduce your taxable income $70,000 to $90,000 per year? $70,000 to $90,000 per year for every $100,000 invested. Show me that strategy, Mr. and Mrs. Advisor. Now, again, there's a lot more that goes into it. You don't, at least in my opinion, you don't ever invest simply because of tax benefits. I love the tax benefit, but I'm more interested in total return and seeing my money grow. But why, if you have $1 million net worth, not including your primary residence, or you're accredited, which is $1 million net worth, not including your primary residence, or you make $200,000 a year single, or $300,000 a year joint, and with the expectation that will continue, you're what's called an accredited investor. Not my rules. I wish it wasn't the case, but it's the SEC rules, and when we have to abide by them. But if you meet that criteria, and you're not being shown strategies that can greatly reduce your active or passive income, or, help on Roth conversions and minimizing the income tax that's due on that conversion, then you're not working with an advisor that has cutting edge strategies. And here's the deal. I don't even look at these as cutting edge. That's the problem. That's the challenge. They're just higher net worth strategies, institutional private equity type strategies, where normally you have to write a $5 million check. to get access to them? Well, we are now, on multiple funds that we've created a fund that we can take $100,000 minimum because, again, that is who we want to advise on. We want to bring that one, again, $500,000 to $15 to $20 million investor. We want to bring those strategies that the ultra high net worth are using and bring them to you. And it's all through education. And that's what we're going to do. That's what we do. That's why I think, we talk with 3 or 4, potential new investors from each radio show. It's because we lead with education. We believe in education, and we will always have that education mindset. That's it. I think we're the best educators out there, and good or bad, take it or leave it. But that's what my job is. How do you make an informed investment decision if you don't fully understand what that investment is and how it fits into an overall plan? So more after the break. 630-492-1912. 630-492-1912.
Planning for retirement is kind of like planning for a trip of a lifetime. First you save and plan every detail. Then comes a day you've looked forward to for so long. Preparation is the foundation for successful travel and retirement. At Kuhn Capital Partners, we believe that foundation is a financially secure and tax-efficient plan that seeks to protect your needs now while looking to the future. Reach out to Robert Kuhn at 630-429-1912 and visit our website, kuhncp.com.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn. Thank you for joining us. Hopefully everybody's having a great weekend. I want to, if you're catching it on the podcast, great. We love to see it. Send it on to somebody you think needs to hear it. That is always appreciative on our end. We believe in education. Yes, we're a fiduciary. Yes, we're financial planners. Yes, we're a registered investment advisory firm. 630-492-1912, 630-492-1912. If you'd like to have a conversation, financial planning, tax reduction, enhanced income yield banknotes. And we think that is something everybody should consider for their portfolio when you can look at, a strategy that's backed by the JP Morgan, Citigroups, Bank of America's, Morgan Stanley's, UBS's of the world. Those individuals, banks are backing the strategies. You can get significant income that can really be a real big buffer if the markets are down. And that's, I now realize what I forgot to talk about in segment 2, the 4% rule. So I'm going to get to that this segment. But if you want to, learn a little bit more about that or tax reduction or some, other, very targeted strategies, including the traditional strategies, just give Paige a call. She'll set that time up for our initial call, 630-492-1912, 630-492-1912. Right now we run the radio show in Chicago. It's obviously where we're headquartered. We have a national client base. I would consider it to be national just based on the markets that we generally work in, with the individuals that we work in. We're looking to expand the radio show to other markets. So we're excited about that. Again, we're just very, very passionate about helping people, putting us on your team. Whether that's managing 100% of your money or managing a piece of it. Again, it's not my agenda, it's your agenda. It's not my team's agenda, it's your agenda. It's not, our firm's agenda, it's yours and your family's agenda. But I can promise you this, that adding us to your team is going to enhance, we believe, greatly currently what you're doing. Whether you're working with other advisors or other trusted financial professionals, now you have us to vet everything as well, and that's something that we're going to be very, very passionate about. So, 630-492-1912. The 4% rule. Advisors are still using it. Can you believe it? They are still using it, which is mind-boggling to me. I just don't understand it. I do not understand it. And they're still using, fixed income, traditional bonds as a means of portfolio diversification when I think, you can get, a senior unsecured debt by the same bank in many instances with, double or triple or quadruple the yield that the interest payment that you're getting by just looking at, different strategies that bank offers. Pick your favorite bond fund. Go pick it. Vanguard, Schwab, I don't care. Pick it. Pick your favorite aggregate bond fund. Forget the bond fund. Look at the AGG. That's what all the bond funds, if you have a intermediate, total return type bond fund that's going to, benchmark it to under 2%. under 2% generally over 10 years annualized. And that's awful, in my opinion, awful. We talked a lot about that today, earlier with inflation, et cetera. But, the 4% rule is, if you take out 4% of your money and, inflation adjusted, you'll never outlive, your assets. And it's like, well, let's look at what that 4% rule is. Let's look at, the individual from Texas Tech that did it and when they did it back, way long ago and didn't include 08. I mean, it's kind of antiquated. And you look at it, money market rates right now that are paying, still north of 4. If you're living on that 4% rule, I have news for you. You can generate significantly more cash flow by looking at the enhanced yield bank income notes. I mean, significantly more. And the beauty of it is if we're getting, north of, let's just say 11 to 15% with the enhanced income yield banknotes. And, that's less money that we have to allocate to get you the income that you need. And then that's more money that could be, in theory, generated to reduce your taxable income or more for growth. So, I guess the 4% rule, if you have a 60-40 portfolio, a balanced cookie cutter portfolio that I would consider not to be, I would never pay anybody to manage a 60-40 portfolio. If that's what you want, go online and buy an ETF that's 60-40 and save that 1% fee a year or 1.5% fee a year. I just wouldn't do it. But the bulk of, advisors out there, that's what they're going to give you. They're going to give you some sort of a balanced, portfolio, growth versus, fixed income. Yet, I mean, that just bothers me. It keeps me up at night why people are still doing that. Well, I'll tell you why, because it's great for the advisor. It's easy. It's easy for them to scale the business and go and increase their revenue, their personal revenue. Doesn't mean it's good for you. Maybe over 30 years it's good for you. But if we look at what good is relative, right? I mean, you'll probably be up, of course, but there's various levels of being up, right? I mean, you think about, 1% and 1.5% and 2% and what that means to an overall portfolio. So we use a manager for our all cap growth strategy, which is our kind of our focus. It's not focus growth. Well, it includes focus growth and all cap, but our kind of our traditional equity strategy. Third-party money manager. We do a lot of proprietary stuff on kind of the hedge fund side, but for this, it's a third-party money manager. They constantly rank in the top 3 to 5% of managers that report into Morningstar. And their outperformance since 95, again, past performance, not indicative of future results. Please understand that. You don't make decisions only based on performance. But I put a little bit more stock in quantitative mathematical model performance than just gut feel model performance for obvious reasons. It's generally more repeatable. But since 1995, that strategy net of a 1% fee is over 12%. And the S&P is around 10.5, plus or minus a little bit. So we're looking at only a 1.5% outperformance a year. You know what that is cumulatively over that entire period? You're looking at over 1,200%. So there's different levels of good. But yet every advisor tells you can't beat an index. All the advisors in Wall Street tell you that you just have to go out and buy passive strategies. I don't know. I mean, if we're in a low interest rate environment or a low return environment for the next 5 to 10 years, man, you better, in my opinion, you better make sure that you've got strategies like the enhanced income yield banknotes that, will generally deliver, 12 to 15%. With 30% downside protection before you don't get those, those monthly interest payments. And you better look at strategies that are called alternative. And I don't like that they call alternative because they're only alternative for the $10 million and under client. You look at the higher net worth client, that's just what they invest in. UBS had some great research on the family office 2020. I think it was 2024. I don't know if they titled it 2025 or 2024, but it obviously was last year's data. But the family office asset allocation, and a family office is really what it is, a family office. It's your family office, your own personal money generally. And usually it's $50 million and above of the family's money. But very quickly, it's mostly, billion or two type, money. But you look at their asset allocation. This isn't me. You can read the report just like I can. It was around 55% what they would consider traditional, which is still different than what you consider traditional, but 42% alternative, private equity. hedge funds, absolute return strategies, other strategies that are just not your cookie cutter, ETFs. And to me, I'm on a mission to bring those strategies. That's why we've created what we've created, on a mission to bring those strategies to the average investor, $500,000 to $20 million investor. You don't have to have hundreds of millions of dollars to have access to strategies. You just need to be working with an advisor that believes in the benefits of alternatives, that believes in the benefits of significant tax reduction, that believes in the power of wealth transfer in a Roth that is, in my opinion, the single best tax-free strategy to transfer to future generations. And yes, that's even to you, Mr. Listener, who has $2 to $10 million and may make $1 million a year. Yes, that it's probably more towards you, but you just haven't been shown it. You haven't had somebody model it out, out to age 95, and paying a little bit more tax early on. When we look at it, we want it to pay it. Of course, we want it to benefit you first and foremost. We want you to have a anticipated higher value. We want you to of account. We want you to have a anticipated lower tax bill. And then the third checkbox is, would it be better, for your beneficiaries, whoever you plan to leave the money to. If you want to leave the money to, you may want to spend every penny you have, but that is what we are focused on. And that's why clients come to us. That's why investors come to us. They come to us because we want to meet those three checkboxes when it comes to financial planning. And if you have $500,000, it could make a ton of sense. If you had 10 million, you may not think it makes sense, but it probably makes the most sense, 10 to 20 million. And so those are the things that we're really, really passionate about. And that's what we're going to talk more about on the radio. I mean, people get tired of, me probably talking about the enhanced income yield banknotes. They do. They probably do. But you know what? Our goal is $100 million. We want to help out $100 million worth of investors. It could be 100,000. It could be one person with 100 million. It doesn't matter to us how many people it is. But I think that if we're in a low growth environment, that people they'll feel very, very good to know that a piece of their money can still earn double-digit returns as long as the indexes are not down 30%. And the bank backing the note is viable. And we're only using the JP Morgan, Citigroups, Bank of America's, Morgan Stanley's, UBS's, BMO's, BBVA's, Goldman Sachs's of the world. So I like that credit risk, right? But that's what we're going to do. So, I know I went over a whole lot this show, but to kind of, land this plane, our goal is to, if you don't have a robust tax strategy in place that models out your tax life each year to age 95, reach out. If you have been told Roth conversions, don't make sense because you make too much money or you have too much money, reach out, because we'll either confirm or deny that with our tax planning software. And guess what? All of that is complimentary. It's just an investment in our time because we want to give that away. And don't think because it's complimentary that it's not labor intensive, that it's not highly sophisticated, because it is. But that's our give to get in front of individuals that want help, and that's all we want to do. So if we can help you when it comes to investing in any form or fashion, we'd love to do it. That's why we do the radio show. That's why we do the dinners. So just make sure to reach out to Paige, 630-492-1912, 630-492-1912. She'll set up that initial consultation, and we'll have a call or a meeting or a Zoom, really whatever you're comfortable with. But I think you're going to learn really quickly that we always put your agenda ahead of ours. But that being said, we're very, very passionate about education. So if we have to correct or explain things that you thought you were sold or you have, but they're not actually that, we'll certainly do it respectfully, but we hope that you respect the fact of our level of transparency and really honesty, because at the end of the day, that's what we got. So give Paige a call, 630-492-1912. More next week.
This recording is for informational purposes only and should not be considered investment advice. Kuhn Capital Partners does not provide legal, accounting, or tax advice. Any statement regarding such matters is explanatory and may not be relied upon as definitive advice. Opinions expressed are current as of the date of this recording, and such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Kuhn Capital Partners. Any reference to guarantees, principal or income, protection, buffers, or defined outcome investments are generally structured notes or fixed insurance products backed by the claims-paying ability of the offering company and are not insured by any government agency. Kuhn Capital Partners is not affiliated with any guest unless otherwise stated and does not guarantee the accuracy or the completeness of any data presented. Kuhn Capital Partners and its affiliates are not responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions in this recording. Past performance is not a guarantee of future results. All investments are subject to investment risk, including but not limited to the potential loss of principal. Advisory services are offered through Kuhn Capital Partners, LLC, a registered investment advisor.